Hi everyone, how do you work out the cost basis for your crypto in the UK and any capital gains tax that may be due once you've disposed of some of your crypto assets? Well, that's exactly what we're looking at in this video, and we're going through some specific examples together, following some feedback that our last video on UK crypto tax might have been a bit too general and complex at times. And I'm pleased to welcome back onto the channel Jamie Nuttall to share his expertise with us, who's the Director of Crypto Tax and Partner at Myna, which is one of the leading crypto accountancy firms in the UK. A quick plea from me to please subscribe to the channel if you haven't already, so you don't miss out on any of our future videos, and so we can keep doing them for you. Just a quick reminder that nothing contained here is financial advice, and let's jump straight in. Okay, hi Jamie, it's lovely to have you back on the channel, and thank you so much for coming on.
My pleasure, mate. My pleasure. It's always a good time when I'm hanging out with you on YouTube, talking about all things crypto and taxation, mate.
Yeah, definitely. So in this video, you kindly jumped on to share your expertise, and we're going to go through probably, I'd say, two basic examples for viewers. The first one is how to work out capital gains tax. So if I maybe give you a scenario or an example, then you can talk us through how you'd work out capital gains tax for kind of just a rough example. And I do just want to say at this stage that everything that we cover isn't financial advice, and it obviously won't apply directly to your cryptocurrency holdings, as it is just an example. So let's say we've bought 4 cryptocurrencies, Jamie, for £10,000, just as an example. So each cryptocurrency is worth £2,500. So 2,500 times 4 would be the 10,000 that we've invested. Then in the future, we sell one of those 4 cryptocurrencies for £10,000. So the 4 cryptocurrencies are now worth £40,000 because they've gone up in value. So 10, 10, 10, 10 to £40,000. What is the tax implication in terms of capital gains tax, and how on earth would you work this out?
Very common question I get here, James, and we can break it down fairly straightforward for you. So just to recap very quickly, you bought 4 tokens or coins for a collective amount of £10,000, i.e. the cost is £2,500 each, and then you sold one for £10,000. So we would need to take down and take note of the initial cost of £10,000 to start off with. That's for all 4. We've already determined the market value of all 4 of them to be £40,000. So you've sold one at £10,000, that would be your proceeds, and then the cost would be £2,500. Now, please note that it's not £10,000 because it's not first in, first out or anything like that. We don't have that in the UK. We have something called Section 104 pooling. We average the cost out in this very simple example. So that means your gains would actually be £7,500. You and I both know, James, especially from previous videos, that we have £3,000 tax-free at the moment per year, known as the annual exempt amount. So your actual taxable gains would be £4,500. Now, since October, we had a new rate of capital gains tax, changing from 10% and 20% to 18% and 24%. So this means if you are a basic rate taxpayer, you pay 18% on that £4,500, i.e. £810. If you were in a higher rate taxpayer or additional rate, anything beyond the basic rate, you'd actually be paying 24% at £1,080. Hopefully that gives you a nice direct summary of your question there, James.
Yeah, that makes perfect sense. Thank you. So if I try and go back through it to make sense of it or explain it in my own words, your proceeds are the one cryptocurrency you've sold for £10,000.
Correct.
Perfect. And then the cost is how much you paid for that cryptocurrency originally. So you invested £10,000 and each one was worth £2,500.
Correct.
So the difference between what you sold one for and what you bought one for is £7,500.
Exactly.
Brilliant. And then you obviously deduct your £3,000 annual exempt amount, and then that gives you your taxable gains, and you work out whether it's 18% or 24% off the £4,500.
Yep, nice and easy.
Yeah, perfect. That's brilliant. So what if we just take it maybe one step further? What happens if, because I think it's linked with your personal income, isn't it? So what happens if you're a lower or a higher rate personal income taxpayer?
Yeah, so in this situation, you'll take into consideration how much of your basic rate band you have left, if you like. So if you have no income, and in this example of £4,500 worth of taxable gains, it's very straightforward. You'll be paying 18% on that, nice and easy. If you're in a situation, say, for example, where your total income through, say, PAYE is £49,270. Now, the reason why I use that number is because your personal allowance and the basic rate band added together is 50,270. So in this example, we've got a £1,000 left over of your basic rate band. What happens here is you actually start straddling the tax brackets. So a small amount of it would be under the basic rate of 18% tax. So in this case, £1,000, £180. And then the rest, the 3,500, would be at 24%, and that would be £840, giving you a total of £1,020 tax. So the key here is to remember that just because you are within your basic rate band and you have something left over, it doesn't mean all of it is going to be taxed at 18%. It's only the amount that brings you up to the basic rate band.
Yeah, that makes sense. So if you are a basic rate income taxpayer based on what you earn, then it's the amount that you earn, the difference between that up to the 50,000, whatever, which is the higher rate band.
Correct.
You pay 18% on that difference.
Absolutely, yes, spot on.
And then you pay 24% on the amount above the 50,000.
That's exactly it.
Yeah, that's brilliant. Thank you so much. That makes complete sense. So if I've got another question, which is your AEA of £3,000, which you've taken off before, obviously, tax, you work out your tax. I know that you can gift crypto before you sell it, before you dispose of it. You can gift some of your crypto to a wife, a husband, a civil partner, and they can use their AEA. Is that right? Or
yes, so there's something called nil gain, nil loss interspousal transfers, where husband, wife, civil partners can transfer assets tax-free. And what you're saying here is you can transfer the assets to the partner before you dispose of the assets, so before you swap, trade, or sell, and then they can dispose of the assets and make use of their annual exempt amount. So it's important to note here that you don't use your partner's AEA. They have to use it. You can't take it off of them, but you can transfer assets to them without crystallizing a gain or a loss, and then they can dispose of it. So in this situation, what's something you might want to do in order to utilize that in some situations is maybe of that 40,000, you gift them £20,000 of it, for example, and then they dispose of one out of the two tokens in the situation. What that means is that each of them would have £3,750 worth of gains each. They can then both use their annual exempt amounts on their individual gains, and therefore they would each have £750 worth of taxable gains rather than 4,500 in total in this situation.
that's really interesting. I haven't really thought of that, but that's also quite advanced tax planning as well, because if your husband, wife, or civil partner, let's say, was a basic rate income taxpayer, you'd probably want to give them more crypto to use up that 18% allowance up to the 50,000, give or take.
Yes.
If you're a higher rate taxpayer, so you're going to use more of the 18% capital gains tax than the 24%.
Absolutely. So in an example where, say, the wife has £100,000 worth of income and the husband has nothing, and we've got, say, for example, £30,000 worth of gains that is about to be crystallized, because it can't be once crystallized. An idea would be for the wife to transfer the assets to the husband, so that will physically transfer one asset from one wallet, or the assets from one wallet, to the husband's wallet itself. And then the husband would then dispose of that token, crystallizing the gain, and you would effectively reduce your tax burden from 24% down to 18% with that simple thing. So yeah, that's exactly what you want to do. And this is where it becomes high-level tax planning. Now, although in theory, as we've just discussed, that is very easy to do, the problem is trying to work out what that gain is from what the base cost is before you even dispose of it, to then do this. And that's the difficult part.
Yeah, and we'll come on to that in a sec. But I suppose the important thing for this is you have to gift it before you sell it.
Yes. So if you have let's pick a random meme coin, Trump token, for example. You cannot convert that into USDC, then transfer it, because you already crystallized the gain or loss there. You have to physically transfer the Trump token itself, and then the partner would dispose of it into whatever it might be.
Yeah, and that's a bit of a slight barrier in the sense of some partners, let's say, or husbands or wives, maybe won't be into crypto, so won't be able to do that. So then it's doing it together, maybe.
I won't comment on that on YouTube, but
Okay.
Come on, guys. Let's you know what to do.
Yeah, definitely. So linking back to what you just said, how would you go about working out the cost basis for a cryptocurrency?
So this brings it back to usual capital gains rules. So it doesn't matter if it's crypto assets, it doesn't matter if it's shares, it's all in the same realm of how to calculate that. We have something called Section 104 pooling in the UK, which I'm sure I've mentioned a lot here. So how does that work? And this is the point where to understand the mechanisms is important. However, there are tools out there that will help, and of course, an accountant can help as well. So I'll take you through a series of very simple examples and variations of, with a maximum of 4 transactions. So say on day 1, the 1st of January 25, for example, you were to buy £1,000 worth of an asset, and you get 1,000 of them. So what that means is each unit is worth £1. Nice and easy. And then 4 days later, you were to buy another 1,000 units of the same asset, but this time it cost you £2,000 because the value went up. So in that one transaction, the second one, your average cost per unit is £2, whereas your first one is £1. Now, with Section 104 pooling, the aggregated total and average here is 67 pence per unit, because you have 2,000 units and it costs you £3,000. Very simple average maths. Does that make sense so far, James?
Yeah, so you're averaging it all because it's within 30 days, is that correct?
You are averaging all regardless at this stage. We are ignoring the 1-day rule, the 30-day rule, and everything else. We're just averaging out, assuming that there's what's to come won't change this fact, which it might depending on.
Okay. Yeah, okay. So most people, I think, would not do that or become confused by that, because they'd work out each individual one and they wouldn't end up with 67p.
Correct. And they might be correct in the situation where on the 5th of the 1st, they were to dispose of some tokens as well, because it's happened on the same day. You would take the £2 average cost in that situation because it's 1 day. But again, we'll get into that in a minute because it gets quite complicated. So let's say after all of this, you dispose of the assets on the 24th of the 2nd. So please note that this is beyond 30 days. So that means everything is pooled to figure out the cost. So you dispose of £1,000 worth, and that was 500 units. So the cost per unit at this date is £2. What this means is that we have to take the average cost, historically 67 pence for 500 units, deduct that from the £1,000 to get a gain in the situation of £666.67. So this is very straightforward and simple. You bought 2,000 units with an average cost of £3,000. You then sold 500 units with an average cost, average market value of £2, and then the difference is your gain in this situation.
Yeah, that makes sense. So I'm not sure about it being easy, but the takeaway I've got from this is, so everything is together. So if you're buying more currency, your cost is for all of it. It's not for those individual ones and then averaging necessarily.
So it works per asset type. So Bitcoin will have its own pool, Ethereum will have its own pool, and you take an average cost of all the transactions normally, but this can change.
Yeah, we don't need to necessarily go to that. So yeah, if I've understood this correctly, so you're buying a cryptocurrency, let's say in this case, for £1,000, and you've got 1,000 units of it, 1,000 tokens.
Yep.
So it's £1 per cryptocurrency.
Yep.
You then invest £2,000 more into that cryptocurrency, and you get 1,000 units because the price of that cryptocurrency is increased.
Yep.
So you then have to work out that you've invested £3,000 and you've got 2,000 units.
Correct.
So therefore your cost for each unit is 3,000 divided by 2,000.
67 pence.
67p.
Correct. Yeah.
Okay, I think I've got it.
Now, with these situations, because of Section 104 pooling, this is when it becomes complicated. Everything that's done in the same day gets pulled together. Everything that gets done in the 30-day period window gets pulled together. And outside of 30 days, everything else gets pulled together as a big amalgamation. So let me propose to you, same situation. You sold 500 units for £1,000 to have a gain of £666.67. If within 30 days, so say on the 13th of March 2025, you were to actually buy back 500 units and they happen to cost £2, because it's within 30 days, you would actually aggregate the two together, and the 500 units you bought back covers the initial 500 you sold. You'd put those two together, so your cost per unit is £2, proceeds per unit is also £2. So therefore, even though you've created a gain, within 30 days, you have removed that gain by buying it back. You've just reversed it. So the headline here is, if you were to buy it back within 30 days for the exact same price you sold it for, you will negate the initial gain in hindsight, which is very weird.
Yeah, but and if the price of that cryptocurrency fluctuates, so the price increases or decreases?
Yes, so let's take another example where it goes to £1.50 per unit. So you sold it for £2 per unit, and then within 30 days you bought it all back for £1.50. Rather than having a £666 gain, it actually become a £250 gain, because it takes into consideration the £1.50 cost per unit, whereas you sold it for £2 per unit. So you see how that changes the calculation completely because of something you do within 30 days.
You're saying the price of the cryptocurrencies decreased within 30 days?
Correct, yes.
The price of the cryptocurrencies decreased, so your gain increases?
Comparative, so you're comparing it to £2. So yes, if you sold it for £2 and then it goes down to £1.50 and then you buy it back, there's still a gain between the two of them. It's just the gain is less than if you sold it at an average cost of 67 pence per unit, as we initially discussed, because now you're selling it at £1.50 average cost.
Yeah, that makes sense.
We're getting into the complicated area, James, where this would be probably a medium level tax exam question.
This is, yeah, we might lose some people here.
Possibly, but at least they were aware of why it's complicated.
Exactly. We'll look at that at the end. So, Jamie, we just looked at one. If the price of the cryptocurrency decreases in the next 30 days and the implications of it. So in this case, we've got a gain of £250. What about the inverse? What about if the price of the cryptocurrency increases rather than decreases?
Yeah, so again, you've sold 500 units at £2 per unit proceeds. And then within 30 days, you buy it back, but the actual price per unit is £2.50. You'd again link the two up. And in this situation, you'd create a £250 loss. So you turn a £666 gain into a £250 loss by buying it back at a higher price, because you've moved your cost basis up. Now, I want to be very clear. This isn't a cheat code or anything, because it does come out in the wash eventually. It's just a way of negating gains if you did it by accident, let's say, or naturally by going, actually, I didn't want to sell that because my arbitrage trading strategy is to increase the value of those assets, and I actually made a mistake, so I want to buy back even though it's going to cost more.
That makes sense from a strategy point of view as well, because most people will want to invest or dollar cost average in as the price is decreasing rather than increasing. So
100% that could be a strategy that they take. And we, as investors, we know a lot of people dollar cost average in something at some point. So you can imagine if you dollar cost averaging every week, multiples of these transactions that affect each other, and sometimes you sell as well on top of all that, or swap or trade or dispose, you can see how it can get quite complicated.
yeah, 100%. So if we do one more, let's say, just as an example, what happens if you buy the cryptocurrency back, but the cost per unit, so the cost of each cryptocurrency, is less than you originally bought it for?
Yeah, so if you originally bought it for an average cost of 67 pence, that resulted in a £666 gain. And then you bought it back after the sale for £2 on average. And then you bought it back after it dumps and it's actually worth, say, 50p, you'd increase the gain to £750 because rather than going, oh, £2 to 67p, what's the difference between there per unit? You're actually going £2 all the way down to 50p per unit. So you go from £666 gain to 750 in the situation. So just because you crystallize a gain, if you were to buy it back at an even lower value, you might actually crystallize even more of a gain if it's within that 30-day window, James.
Yeah, yeah, that does make sense. And I think this hopefully is showing people that, going back to the original capital gains calculation, that it certainly does make sense. But then when we look at things like section 104, pooling the 30-day rule, even the 1-day rule, and adding levels of complexity, if you've got loads of transactions on, of different cryptocurrencies, you're using different crypto exchanges and different blockchains, etc., just how complex it can be.
And that's exactly it. This is a 4-line demonstration with many different results depending on the market price and depending on what you do. Now imagine this with thousands of transactions, hundreds, tens at least, if not hundreds of different asset classes, as well as data that can be questionable. It gets quite complicated. So I would say this is the main reason why software is almost compulsory at this point. Yes, as an accountant, I can deal with this manually. It's going to take me a long time. Software will take care of most of this. And that's before we even get to the base cost and calculating the tax itself, as we did in the initial part. So yeah, software, even if you're an accountant, you should absolutely be using it, because this is a very basic situation. And this whole thing, we're not taking into consideration meme coins, let's say, or NFTs or anything else that can be more difficult in order to receive these individual unit costs in the first place, to then amalgamate the total for when you actually do your tax calculation.
Yeah, so your advice for individuals in terms of trying to work this out is use software as that starting point. Are there any downsides to doing that with automated tax software?
Yes. So, and it's not the individual's fault. I know it's a marketing thing from some software providers where they say, do your taxes within 10 minutes or whatever it is. It's like, well, yeah, but it's going to be incorrect is the honest answer. So why is that? Because the software does this. How does it still do it wrong? The reason for that is when you are obtaining the data, if it's, say, Ethereum, Solana, maybe a bit of Bitcoin from an exchange, the data will mostly be fine. Even then, with centralized exchanges, there can be issues, and there normally is. So what are those issues? It's the fact that it will miss a transaction or two, or maybe it's got the market value incorrect, or maybe there's an issue with the units itself because of the transposition of data has slightly gone awry. So that can cause issues in itself. The individuals have to go through the software and pick out those issues, for starters. Another issue that is quite common is that they don't link two transactions. So you see Ethereum going out from one wallet and then Ethereum coming in from another wallet, but they don't say that that's the same transaction. So it looks like you made a disposal and an acquisition when in fact you just moved it from one wallet to another, which isn't taxable, by the way, because as long as you own both wallets in its entirety. And that's the tip of the iceberg there, James. And it's at this point where you fall back into a traditional bookkeeper type role to make sure that each transaction is bringing in the correct data. And yes, you can look at them in bulk, in batches, per wallet, per asset class, depending on the situation, but you still need to look at the individual transactions in some format in order to make sure that that data pulls through to this base cost calculation, which then in itself pulls through to the tax calculation. So the tax calculation, very straightforward for most people. Software can deal with that. Basic accountants can deal with that. The actual base cost calculation, you need to have a qualified or someone who has a qualification by experience with capital gains tax, generally speaking, to get that right, or use software. To get the actual data in the software correct, that's when you need a specialist crypto tax personnel. Not everyone needs that. It depends on your situation. But the more complicated protocols you get involved with, the more difficult it is to deal with that, and the more likely you'll get it wrong unless you use a professional.
Yeah, even trying to work out the price of the cryptocurrency at a particular time or date in the past, if the automated crypto tax software has not pulled that through for whatever reason, that's even complicated within itself.
That's exactly it. And like I said, that's the tip of the iceberg in terms of what could go wrong on software. Here's a big spanner in the works here for you, James. If you were to get two like the same portfolio, one person, same portfolio, and put it into the different tax software and not do anything, because they have their benefits and their issues, they will pull things in through that are correct on one aspect and wrong on another, but do it the same in a different software where they bring in something incorrect on a different area and something correct in a separate area. And if you were to look at the tax calculations on the software without touching it, same data source, the likelihood of them being exactly the same is near on zero. They could in fact be wildly apart by multiples of hundreds of thousands of pounds in some cases. It doesn't mean there's one better than the other. It just means they've done it differently, or they've got an issue in different areas that need to be fixed. So you need to pick software that you're comfortable and know which area needs to be fixed, depending on your situation. It's very complicated, James, at this point.
Yeah, I hadn't thought about that. The different softwares would see it differently, and obviously I know that they support different numbers of blockchains, etc. So that does make sense. As I look at this, for an individual, trying to work it out yourself, unless you've got very, very few transactions and very, very few cryptocurrencies, working out yourself, in my opinion, is a bit mad. Using software is great, especially as a starting point. And then using someone like yourself at Myna, a crypto accountancy firm, a reputable one who knows what they're doing, if it does get complicated, then kind of having the peace of mind and saving yourself the time of having to go through the tax software online and going through every single bit of it would benefit quite a few people.
Yeah, it does boil down to the individual. So for example, someone might take 5 minutes to go through it because they know what they're doing and there's very little. Someone else might take 5 weeks or 5 months to go through it. Now, the amount of time that you're wasting there in an area that you're not an expert on is likely going to far outweigh the cost of a specialist in a lot of situations. And that's just your time, let alone the expertise, let alone the backing, let alone the experience, let alone what they might find to save you taxes or save you penalties and interest in the future by not getting it wrong in the first place. So it really does depend on their situation. I do have a few meetings a week where it's a very quick 5-10 minute call, and after a chat and maybe looking at their Coinly or their recap or their crypto tax calculator, I go, look, you don't need us at this stage from what I can see. I can't guarantee it until I do the work, but based on what I've seen, you're likely able to deal with this yourself if you want to. Now, I know my business partner's going to kill me for this, but that's the honest truth. That's just how I operate. If you don't need me, I'll tell you. You're still welcome to come along. I'm more than happy to onboard you. But it does vary. It really does vary on the individual. It depends on what they're in. And let's be honest, the multiple combinations here are infinite of what you could hold, what chains you're on, whether the software itself accept the API keys, whether you need CSV files. Is the data even available because you've dealt with something in, let's say, 2016 that no longer now exists? Maybe you're dealing with Celsius or FTX in the past. That in itself has its own issues, problems, and solutions. So yeah, this is supposed to be tip of the iceberg, and it genuinely is. But now we're starting to get into the realms of, okay, now I know what I don't know. I'm more wary of it, and I can make my own justified decision whether I use, as an individual, an accountant or not, a crypto specialist or not, and software or not. I think less than 1% of people listening here will not need to use software.
Yeah, I agree with that completely. It's the cost. It's the cost of your time and your knowledge, or leveraging someone else's knowledge, or leveraging the knowledge of a automated crypto tax software. If Jamie, if people want to get in contact with you or educate themselves more on crypto tax, where can they find you? Where can they contact you?
Absolutely. So you can go to our website, Myna Accountants. And what we tend to do is have a 15-minute screening, quick conversation to see who's best suited for you and what services you're after.
And yeah, I've also included a link in the description of this video. If you want to contact Jamie directly at Myna to use their services and to get in contact with them, you can use that link, and it's an inquiry form. You can put in your information and it'll go directly to them.
Yeah, exactly that. And if they need our services, I'm happy to give them the consultations for free if they've come from you. So please do mention you come from James from Coin Knowledge, and you'll get that. Now, if you're looking just for general aid or wanting some questions answered ad hoc and you're not quite sure how to deal with this, but you want to yourself, if you look up Crypto Tax JME on TikTok, X, or even YouTube, there's a plethora of data on there that can help you with this type of thing, especially if you want to do it yourself. In fact, my latest video is a full disclosure on how to deal with your taxes yourself from top to bottom. And if you can't find anything on there and you have specific questions, just go to my latest tweet, go to my latest TikTok video, and just comment on there a question. I try and get back to as many people, if not absolutely everyone, with some form of reply. Sometimes the reply is very straightforward. Sometimes the reply is in terms of a video itself. Sometimes the reply is, this is far too bespoke, or I need more data on this in order to answer it. But happy to help in my spare time.
That's brilliant. Thank you so much, Jamie, for jumping on, for going through those 2 examples. I know it got a bit complex with the pooling and stuff like that, but invaluable. So thank you so much.
My pleasure, James, genuinely, and always happy to support you and your channel.
So hopefully it's helped to go through some examples looking at working out your cost basis and capital gains tax on crypto in the UK. As always, I'd love to know what you think in the comments below, and any videos you'd want to see me cover in future. If you're looking for more specific crypto tax advice based on your personal circumstances, and you'd like to get in contact with Jamie at Myna to get them to work this out for you, then I've left a link in the description of this video where you can contact them directly and book in a free consultation. You can also sign up for a free account with Coinly using the link in the description to this video, which is one of the best automated crypto tax platforms out there, and is a good starting point when trying to work out your crypto taxes. Just a reminder that if you're interested in more of a tailored approach to your crypto education, and you think you'd benefit from having someone look over your shoulder and guide you on your journey, I do offer one-to-one coaching to those who have the desire and the means to educate themselves further. And there are links in the description where you can message me and book in a free video call to see if we'd be a good fit. I've also included a link to Trezor's website in the description of this video. For anyone looking for one of the best hardware wallets or cold storage out there in our opinion, with 2 new models in the Trezor Safe 3 and Trezor Safe 5, that I actually did a video on, you can find a link to here and in the description. Linked with that, we're pleased to have partnered with the #1 best-selling crypto seed phrase storage firm called Crypto Tag. And again, I've included a link to their official website in the description of this video for anyone looking to protect their seed phrase, which is vital. And finally, if you're looking for a portfolio tracker for your crypto portfolio, then I've included a link to CoinStats in the description of this video, which is the leading crypto and Bitcoin tracker on the market. And if you found this content interesting, please do like the video and subscribe to the channel, as it honestly really does help so we can continue building and offering videos in future. And have a great day.